It's always dangerous when you let the macro economy control your micro economy. And when we talk about, the household economy, those decisions, like when property market was on the run and people are chasing it to get into it.
Yeah.
If you see share markets falling, it doesn't mean that you'd necessarily your household economy is ready to try and chase that either.
We've got some fresh new young talent doing some things that I know you haven't heard before.
1, 2, 3, listen.
Welcome to Finances, your home for all things financial, investment, money and lifestyle. Hosted and curated by the very talented team of certified financial planners, Burke Britton Financial Partners. Well, this is the Finances podcast. This is, what are we in March?
I thought you were going to guess the episode number. But
we don't do episode numbers anymore.
Good. I did one the other day and I said I'm not even going to guess, so that's good. We'll know more numbers.
No more numbers. But this is March. We were a bit slack this year. There's been a bit going on. I had most of January off. That's
nice.
Yeah.
We've hit the ground running this year, though. Like a lot has, happened in a 3-month period.
You mean Trumpy?
Other than what's happening in the States.
So this one, I thought we'd talk about some of the topical things. What's the date today? It's the 28th of March, Friday the 28th of March. Hopefully we can get this out in the next week. So it's topical. What did you have, Ben? We're going to do this as like a Q&A. What's hot at the moment? What are we hearing clients talk about?
It probably comes back to a little bit what I just joked about, but a lot about markets and the Trump effect of him being in office, and it's topical because it's in the news. It's everywhere you go. It's very clicky. So that's what I say to clients. If stuff clicks, it's going to move the markets. It's an emotional thing. So we'll probably just, again, expand on that a little bit without being completely obsessed by it as most people have been.
Delta and I shared some appointments last week in Shepparton. How many clients do you think asked something about the US or Trump and the effect on their money?
I'd say most of them had some concerns, yeah.
How did I do articulating?
I think you did a very good job of trying to broaden their horizon, perhaps, and have a think about the markets over a much longer term rather than being reactionary to events that are occurring.
Sure,
love you to.
I'll talk about how I spoke about it with clients.
Do you want me to? I'll ask the question.
Yeah, sure, go for it.
GJ, do I need to be worried about what's going on with Donald over there?
Well, it's interesting you ask that, Ben, because Delta and I have had a number of appointments today where clients ask exactly the same question. What I have said to clients is that it's like the world lives in two alternate universes. So if you are speaking to one person, they will be very anti Donald Trump and whatever's happening in America. You talk to another person, they're listening to a totally different source of their news, and they'll be totally wrapped with the approach. The reality is somewhere in the middle, and we had our investment committee meeting last week with InvestSense. We also were on a call with Shaw and Partners just earlier in the week. And one of the things that the analysts are very good at is just being super objective. And I think that's our superpower as financial advisors, is that we don't get caught up in the news cycle. We're all bound by getting a little emotional about certain things. But if we look objectively at what's actually happening, and I think you mentioned it pretty good earlier, Ben, it was off air, that everything that Donald Trump is proposing to do are things that previous administrations have talked about being important. So getting rid of excess spending, reducing government spending, reducing the deficit. But no one has probably had the willingness to do it or try to attempt it in such a short period of time. Now, we can argue all day whether it's a good or bad thing, whether it's done for self-interest versus the good of the economy. The reality is that that government spending in the US is significantly beyond what they generate. And if the US is in trouble, it probably has an overflow on the balance of the world. I think if what Donald Trump and the administration is doing at the moment, if they're able to succeed with a portion of what they're proposing, reducing debt, increasing revenue, being pro-business, it's reasonably good for the world, for the US. However, obviously, there's some risk with it. There's risk with everything, and so I think rather than taking a polarising view on this and being either very pro or very anti, we've got to look at the hard and fast numbers and look at, the market did have a correction. The market's had a correction of roughly 10% in the month from February to March. How do we look at that as financial advisors? Well, for most of our existing clients, have told them for a long time that markets correct. Markets, for whatever reason, whether it be a change in administration in any country, mostly in the US, it potentially has an impact. Tariffs have an impact. Currency has an impact. Interest rates have an impact. But what are the things that we can control? Can you control what the US government does? Probably not. Can you control what you invest in? Yes. Can you prepare for market downturns so that you can look after your own financial affairs? Yes, you can. So let's focus on what we actually can control, and that is whether it be the Kemp household, the Smith household, or the Burke household, we can control what we do with our money and how we invest it. And so the long and short of that is try not to get too emotional about what the markets are doing and try not to be too reactive to what we see in the news. Because 50% of people are going to hate it, 50% of people are going to like it. But at the end of the day, you want to be in a position where you can take advantage. If there's crisis, be able to take advantage of that and see it as an opportunity. So there you go. That's my take.
It's always dangerous when you let the macro economy control your micro economy. And when we talk about, the household economy, those decisions, like when property market was on the run and people are chasing it to get into it.
Yeah.
If you see share markets falling, it doesn't mean that you'd necessarily your household economy is ready to try and chase that either. So take it back to your household, take it back to what's happening in your world, and then expand out from that.
How have you, if you've had that question asked from clients about the change in administration in the US, it's obviously very topical, but how would you answer it? Like in terms of the response to clients, how does it impact them and what should they be doing, if anything, to change their circumstances to cater for it?
It depends. I'll answer it as the clients who, maybe some of our younger clients who are growing their exposure to the market. So again, for them, most of them actually understanding that this is a great opportunity rather than a massive impost on their long-term financial growth journey. So
just explain why it's a good opportunity.
Volatility is fantastic for markets if you're actively purchasing into the market. So if you go back and, in many ways the market, you're going back 6 months roughly in terms of where we're at now from a valuation point of view. So maybe if you weren't in the market 6 months ago and you felt like you'd missed out on some opportunity, well, it's 6 months down the road and we're back at the same point. Now, that happens all the time. It happens week to week, day to day. With our clients, we have a pretty structured process where we're buying regularly. We're trying to ignore emotion. Like in some ways, if we just turned off our news, turned off Facebook, everything, and we just continued to do exactly what we're doing, and each month we have a set day where X amount of money falls into the market, we'd look back in 2 years, 10 years, 20 years, and we'd be very, very happy with what we've done. Whether we had, the current conditions or a very boring, mundane, sideways market, if we do the right thing for a long period of time, we're going to be okay. Now, if we're looking at it and we are a little bit more actively involved in it, maybe we're making a couple of tweaks to strategy to try and maximize the upside. So for one of my clients, we had a discussion. They're averaging a fair portion still into the market. They're in the early days in that cycle. We decided to just increase our installments for a period of time through this year, still leaving ourselves a long, long time to go to continue averaging that money in. But we agreed and they felt like in their position, they would like to try and make the most of the volatility. So we'll increase those installments for a little while and then we'll go back down to our pre-arranged level of contribution. Now, for other clients, it's been just the status quo, continue just plugging away, doing the same thing. The last thing you want to do, and I have had these conversations, is where clients want to pull back from it and not continue to be an active purchaser in these markets. And that's a big risk for them because potentially if the stars align, as you sort of mentioned, Jay, and we get through the back end of this year and a couple of these big winners sort of do kick into gear, the market could be in for a really strong period.
So just talk about a couple of, because we had obviously the Shaw and Partners guys on, Sam and Adam. and then we had JT last week with the investment committee. What are some of those big ticket items? Just to get a bit granular about what some of the big ticket items that potentially, if they're successful, could actually be reasonably good. So there's that disparity. Again, the two universes I was talking about. It's either really bad or it's really good. It's kind of somewhere in the middle. What are some of those big ticket items that if they get it right, the market could get favourable conditions?
There's probably lots of smaller ones. Trying to speak of one that's topical. Maybe we'll talk about Elon and Doge.
Yep.
So, can correct me. Was it Department of
Government
Efficiency?
Yep.
So, I think they've already shown there's actually been quite a curve of expenditure. Again, there's maybe been some overcorrection in some areas which they're remediating. But if that actually gets under control and the US government gets its cash flow in order, a bit like a household, they will be better placed to invest in their own manufacturing and their own economy internally, which in turn will actually flow out into a better, broader macro global economy. So it's a challenge, and no one's really tried to bite this off, and it's aggressive. But if that came together and things aligned, then you could see some prosperity off the back end of this, maybe through the back end of this year, or maybe it's a bit more medium term, but that's a big one.
It's interesting when you draw the parallel between households, because the US government is 2000. The deficit in the US is around $2 trillion supposedly.
So their debt is equal to their GDP. Their debt is, I can't remember the figure here, 30 trill. And their GDP is 30 trill, I think it is. And they're in 2 trill per year deficit. $37
trillion is the...
And it's equal to their GDP, I think, broadly. That's about ballpark. So if you think about that from a household...
I think it's actually more than that, but anyway, don't quote us on this. We'll put it in the show notes.
Yeah. Too many TikTok reels. There's a lot of debt.
So if you as a household, let's say you're $20,000 a year in deficit, right? Now, unfortunately, a household doesn't have the ability to print money. The governments do. That printing of money to cover that deficit is one of the things that cause that inflationary effect. It's one of the reasons post-COVID, when a lot of governments around the world printed money, put it into people's pockets, put more supply of money into the system, that everything got more expensive. That inflationary issue is something that all economies, governments are trying to get under control. If you get that under control, how do you get that under control? Well, it's a combination of decreasing expenditure, which is Doge, increasing revenue or receipts, lifting your income. As a household, you look at your own personal budget, you say, well, what expenses can we cut? Actually, I've got to do a bit of overtime. I've got to generate a little bit more revenue, bring us back to that sort of neutral position. The same happens in government, and the US being the biggest player in the world stage. If they can get that under control, to your point, and they can encourage production and business and manufacturing in the US is strong. That flows on to the world economy being strong. So, like you said, if they get a portion of that right, I think it could be particularly good for markets. If you get it completely wrong, okay, there's, like, I think JT might have mentioned that you get that wrong, and there's conflict in Russia, Ukraine, Middle East. Obviously, things could go pear-shaped, but I'm always been optimistic, Ben. You know that. Yeah,
always.
If you're having that conversation, I know you and I had some conversations about the impact of sort of global events. How do you think about it, and how do you talk to clients? And have you had similar questions?
Yeah, definitely had similar questions. I suppose, again, it's the things that you can control. So as a household, the other thing that you control is the level of risk that you choose to take with your investments, whether or not this is a particularly opportune time to look at changing that, for example, whether you do that over a period of time. And the other part to that, I suppose, is around the particular phase of life that you're in. So, yeah, potentially if you're an accumulator, and as you touched on, Ben, you see this as an opportunity to get into the market, versus perhaps if you're on the flip side and you're drawing down on your wealth, could you, change the level of drawings that you're making for a period of time. But ultimately, we structure our client portfolios, so we're never at panic stations. We're never thinking, there's been a bit of a market correction and all of a sudden we have to sell everything just to be able to feed you. We always view things with that longer term, and it's always an if, not a when, those events might happen. Sorry, a when, not an if those events might happen from a market perspective.
You also mentioned that we kind of tailor our advice like to the client. Like I can think of an example right now of a client where it's the opposite of what we just talked about. All right, so you said that the market's actually been very good. We had a dip, but I think we're talking about portfolios just before we jumped on, and portfolios have like quite robust and have held their own over the course of the last month or so. I've got a client that in their own personal circumstances have decided that risk-wise, it's probably time for them to redeem, extinguish some debt because they've got another objective. They've got another financial objective they're trying to address. And so some of that medium-term risk in the market, the uncertainty, to your point, they're weighing up that risk. That makes sense for them. So rather than just take a big blunt instrument to everyone's situation, as advisors, our superpower is to deal with you individually and what your needs are. So it's Delta and Lee's economy. It's not worrying too much about what Elon and Donald are doing in the US or anywhere else in the world for that matter.
And this is probably the Peter Burke playbook, but if you look at, retirees and they're drawing income to make sure they're comfortable in retirement, our portfolios are focused on income and they're often producing more income than clients are even drawing from them. So, the capital value, whether it goes up, down with Trump or the next administration, really ultimately makes no difference to them.
Yeah, I think Peter, I'm sure there's a podcast out there, one that we did where Peter talked about that, the sort of the income effect, investing for income. If you've done good planning and your capital is invested wisely, do you need to actually, and you've got your ducks lined up in terms of when you're going to need access to capital, do you need to sell when it's bad? Are you still getting income? If you've got investments that are generating income and meeting your needs, why would you panic and sell? You wouldn't. And I used this statistic a few times before. Historically, people think that market downturns are forever. They're not. History
It's actually quick, aren't they?
Well, the history says it's from top to bottom to top. The shortest period of time is 9 months from top to bottom to top. So that's from the top of the market to the bottom and then back to where it was before the drop. And the longest time frame ever is 36 months. So 3 years. And so what most people do, and I reckon I've said this 85,000 times on the podcast, is people, they buy when it's really good because they think, it's been great for the last 12 months. I'm going to go and whack some money into the market. If they came and saw us beforehand, let me use that as an example. Client comes into you, Ben, and he says, listen, Ben, I've seen that your portfolios have done 20% from January to January, and I've got $500,000 and I'm ready just to drop it into the market. I'm super excited. I want some of that action. What's your conversation?
I had a similar conversation. So I had the client ask the question. They said, what was your return last 12-month period? And I said, I'm not going to tell you because at this point, because it's not realistic that's an expected return in a normal period. Like, it's been a very strong year. And after a bit of context, I did tell him what it was.
What was the context that you added to that when you say this is why the last 12 months is not necessarily a perfect indicator of...
Well, if you look at historical returns, not very often do you get a year of a 20% return or north of that. And when you line that up with 2 years in a row of ballpark those returns, then you're really into an area that's very, very rarely seen. So based upon history, it would suggest that there's likely to be some people taking profits. There's likely to be, it's probably not sustainable. You have another 3 years, a third year in a row at that similar level. It doesn't mean it's impossible, and it doesn't mean you don't invest, but you just do it with a little bit of caution and some powder dry.
Let me start. I'll answer. I'll throw a couple of other assumptions into this client. The first one is that the 500,000 is 500,000 he's drawn off his home loan. He's got it available and he wants to invest it.
Has an equity redraw.
How comfortable, and that's all he's got. So he doesn't have any other cash reserves or anything like that. No other assets of note, but he's got some equity and he wants to dump it all in. How comfortable are you with that?
It depends. Depends how old they are. Depends what his situation is, his risk tolerance level, his experience to debt, his experience to investment, the stage of, in his journey. If he's 64 and he's going to retire next week, well, it's probably definitely not the right idea. But it could still be. Yep. You don't know. if they're young and they've got that situation, maybe he's on a high income, good cash flow, looking for some tax, tax efficiencies.
Yeah, would you drop it all in at once?
Definitely not.
Okay.
In any way. I could rarely think of, I probably can't think of any example where you drop it in all at once. And
I'll give you another one. So it's a similar person, but he says, I've got 500 grand to invest, but he says, I've actually got 20 mil. I just want to put 500 in straight away, and you can give me advice on the rest. How does that change the conversation?
In terms of he has 20 and he wants to put in 500,000.
Yes, he's got 20 mil that he's open for you to give him advice on, but he wants to put 500 in straight away.
It depends how open he is to what he wants to do with the balance of that. Like if he says, yeah, I'm happy to invest 20 mil, I'm happy to start with 500. Well, as a portion, it probably makes sense, and you probably would start with that, but you'd want a very firm plan around when your next installment. And the risk you run is if you don't have a firm game plan, is that you start to become reactive to markets and you become emotional. And as soon as you get emotional and you try and be too tactical on the run, you're going to fail. So if you go, right, here's 500 and we're doing 100,000 every fortnight for the next 3 years, maybe that's a better strategy. And then the challenge is sticking to it and it's keeping everyone aligned on that journey to stick to it. Because if you just say, oh yeah, we've got heaps of cash and we'll drop a bit in here and we'll do a bit later on, and you're trying to pick and choose, you're going to get burnt.
Yeah. Joe was our videographer, was asking us some questions earlier today, and I was talking about the difference between what's the difference between a good financial planner and a bad one, and I had to think about it for a bit. But the way I thought about it is that our view on someone's situation is beyond just the transaction. So that the example I was trying to get to there was if someone just comes into you and all you know is that they've got $500,000, a bad financial advisor just gives them advice on what to do with that without asking them another follow-up question. You said it depends. Delta, what are some of the questions that you ask clients when you're trying to, I don't know, understand their broader circumstances? They come in and they come in because they've got one thing that they want to talk about. It's the market's done really well, I want to invest. What else do you ask to actually unearth, whether it's good, bad, or otherwise? And what are the other things that are connected to their investments that you also ask them about?
Yeah, I think if you go back to the example you gave with the $500,000 to invest with a client that has $20 million in other assets, the thing that differs there from that first example is the actual capacity for that person to take risk. So that's what we're seeking to understand, where we ask about any dependence they might have, their capacity to generate income. Are they working? What other debt positions do they have? We're seeking to understand everything about their financial circumstances before we would be willing to commit to a strategic plan around what to do with that $500,000. What do their estate plans look like? Are they a blended family? Like, we leave no stone unturned in that respect. We want to understand the immediate implications of any advice that we might provide, but then the follow-up to that and the follow-up to that and the follow-up to that.
The balancing act for us is that we might be a little bit annoying, like with like sometimes turning over a few more stones can feel like it's frustrating, can be maybe slow the process down a little bit, but again, I think it's when we start to talk about mitigating risk, asking those questions and trying to understand the why. I think that's, I don't think we said it, but one of the first questions is when someone says they want to invest, is why? Like, what is it? Is it for kids' education funding? Is it super? Is it retirement? What is the purpose of this? You're trying to minimise tax? Do you need income? Is it for capital growth? You're trying to get capital gains to offset a previous capital loss. Where's it going to be owned? Is it a family trust? Do you have the ability to own it in different structure? All of those questions come beyond just the initial inquiry of, I want to do some investment.
I think the key to that is that we're looking at like decade-long and like multi-generational relationships with those people. We're not looking at a fortnight or a week or a month. Like, when we're looking at that, we're not just thinking, oh, how good this will look in a month's time when we've finished that bit of work and we've been paid and they move on. We're thinking, how good is this going to look in a decade's time when they're about to retire and they've just helped their 2 kids get into their first home and they've got grandkids on the way. Like, we actually look so far ahead that we're looking in areas they wouldn't have even thought of when they come in. And sometimes people look a long way ahead but aren't looking at the right now either. Like, sometimes, rarely do you get a client that's looking now in the medium term and the long term.
That sounds a little bit like tactical versus strategic thinking, doesn't it? And that it's kind of the way we function, is that there is there's definitely, particularly when clients come for the first time, there's a bit of tactical stuff, like there's a bit of housekeeping, there's a bit of cleanup. I know you've talked about that idea of like a bit of a financial health check, tidying things up.
Stock take. I was talking to Joe about it earlier. Like he was a bit. I think he was a bit miffed by what I started saying, but I said it's a stock take. Like we're doing a cash flow stock take on what's what and where is it going, and then we'll build some strategy out from there.
Yeah, and the stock take is kind of tactical, but if you have, like you said, if you have it through a strategic lens, which is what's the big picture, what are we actually trying to achieve? Some people are really good at thinking big picture strategy. Others are very sort of stuck in the weeds. Superpower for us is to be a little bit detached and be able to look at both of those at the same time, and then have the capacity with a team that can give people their time back. One of the things I said to Job earlier was that we have the ability to give time-poor people their time back. Like most of our clients that are engaged in actually getting advice and want to grow wealth, they've got stuff going on. They're running businesses. They've got income streams coming from. They've got family. They've got properties, and they're time poor. So they might have good cash flow. They might have a reasonable amount of wealth. They've got a good basis to start. But what can we actually help them with? We can help give them some of their time back. And if you give people their time back, you reduce their stress levels. If you reduce people's stress levels, generally they make better decisions. If people are making better decisions, they generally don't take risks that are not suitable for them. So they were kind of the intangible values of advice that I thought, outside of investment returns, tax saved, a statement of advice, a document that shows some numbers, that we give people their time back.
And there's lots of studies that support those outcomes for advised clients and their level of financial well-being and stress, and financial stress really impacts on people's health. So ultimately it's it's the financial and the lifestyle aspects that we're making a difference to.
Don't you love how we only need one topic, like you just say Trump,
and one word.
We said one word and we talk for half an hour about the interconnectedness between whatever Trump is doing and our clients. I think that's probably enough, unless you've got anything else. Anything else topical that we want to throw in there? Have we got anything?
I think that I think we've wrapped that up pretty well. Yep. I think the thing with just all of that is that news cycle, and there's a lot of the things that you will click and read that are maybe more like social agenda items rather than the actual like economic functions that are happening underneath as well. And that's all of those things. It's not that they're not important, but emotion will drive markets up and down, and uncertainty is the worst possible thing for markets. And at the moment, we're just getting a lot of uncertainty and a lot of confusion in a time that we're not used to. So that's what's making markets go a little bit crazy, and then the dust will settle, and then people will go back to fundamental analysis, and things will be okay. Yeah.
You're very, very objective, Ben. I like this. And if it hasn't been recorded yet, but you're about to release a podcast, I think, when do you record with JT?
Tuesday, so we'll get that out as soon as we can, which again, we'll sort of, and if you think I'm objective, wait till you hear JT's take on it all.
So if you're listening to this and you want to cut through the bullshit of, Trump versus Biden versus whatever in the US, or even here, when we didn't even talk about the budget and the election here, but if you want to cut through all of that and just think about objectively what's happening in the world, tune in to listen to Ben and JT next week, where we give our sort of market wrap and sort of the summary of our investment committee, which we held last week. It comes out every quarter, and I don't think I'm talking out of school here in saying, mostly for our existing clients, we will very shortly have a portal that goes live on our website at bbfp.com.au, where you can jump in and see some of our reports for our portfolios, and also some of the sort of objective analysis of what's going on week by week, month by month. So look out for that. We'll put it in the show notes. I don't know. We didn't talk about anything else. We've run over time. We talked for an hour before we hit record. Delta's written no notes.
Zero notes. She's taken nothing from today.
Anyway, it's good to get the mics back on and talk to you guys. We should do it more often. So that's it. We'll see everyone next week.
Episode.
Cool.
Thanks, Joe.
Thanks. Bye. We hope you enjoyed today's episode. If you're keen to understand more about how financial advice could benefit you, follow us on Instagram, Facebook, and Twitter at Burke Britton FP, or Google Burke Britton Financial Partners. Check out our client reviews, testimonials, and make a time to meet one of our certified financial planners by clicking Book Now on our website. Thanks for listening.
Any information contained in this podcast is of a general nature only. No account was taken as to the objectives, financial situation, or needs of any particular person. Therefore, before making any decision, listeners should consider the appropriateness of any information with regard to their particular objective, financial situation, needs, and seek independent advice from a licensed professional specific to their circumstances.
All right, hit it.
That translates to, don't be a moron and act on what some random person says on a podcast. Take personal responsibility, do your homework, ask questions, and speak to an actual human that knows what they're talking about before you do anything. PB Financial Solutions Proprietary Limited, trading as Burke Britton Financial Partners, are authorised representatives of AMP Financial Planning Limited, AFS, licence number 232706.